Chapter 3, Personal Financial Planning and Investment. Right here, you're going to learn the different forms of investment, and you should know the personal financial planning at different life stages. And you should be aware of the Mandatory Provident Fund Scheme, what we call MPF. As well, you should know the rights and responsibilities of individual investors and consumers of financial services. First, in terms of investment, you are here to learn different kinds of deposits, and you should learn what bonds mean. Right here, I would like to teach you the differences between debentures and bonds, right? And about shares. Shares as another meaning of stocks. All right, before we go to the savings, we now try to teach you the differences between debentures and bonds. Okay, I adapted some information from the internet to let you know more about the differences between them. Okay, there are types of look at this. Okay, look at the types of debt instruments. Okay, let's look at this. Okay, debt instruments. That means borrowing from the by the company. They are used by the company in some markets. In India, for instance, these two terms are interchangeable. That means these two terms are the same. But in the US, they refer to two separate kinds of debt securities. Okay, the second paragraph, the functional differences center around the use of collateral. Collateral means security. That means something that has to be put in the company, in the lenders of the debts. That if the company fail to pay off all the debts on time or the principal on time, the investors can sell off the collaterals for money. And okay, go on. And they're generally purchased under different circumstances. Okay, first of all, bonds. Okay, bonds are the most frequently referenced type of instrument, very common. Okay, serving as an IOU between the issuer and the purchaser. An investor loans money to an institution such as the government or a business. The bond acts as a written promise, something like a note with the signature on it, to repay the loan on a specific maturity date. Normally, bonds also include periodic interest payments over the bond duration, which means the repayment of principal and interest occur separately. That means the interest will be paid regularly, while the principal will be paid at the end of the maturity date. Bond purchases are generally considered safe, and highly rated corporate or government bonds come with little perceived default risk. That means what we're talking about bonds refer mainly to highly rated corporations or government bonds. We say government bonds, we rarely say government debentures, because the bonds are usually referred to the debt instruments that without specific purposes, but with little perceived default risk. Default risk means the not being able to repay the principal. Okay, let's look at the debentures. Debentures have a more specific purpose than bonds. Okay, look at the meaning of debentures. Okay, have a more specific purpose. That means they are usually issued for some specific purposes. Look at the second sentence. Okay, they're issued to raise short-term capital for upcoming expenses. That means to pay off the daily expenses, operation expenses, or to pay for expansions. That means if a business have a big project in the coming periods, but without sufficient amount of capital, the company may issue debentures for expansions. Sometimes called revenue bonds, because they may be expected to be paid for out of the process of a new business project. That means, say for example, the business want to raise capital for building bridges, okay, which need toll, okay, tolls paid by the car drivers. That means the debentures or bonds revert to revenue bonds, in which the expenses are to be covered by the process of the tolls, okay, or the tolls once the bridge has been built. Okay, but remember, debentures, the last sentence, debentures are never asset backed, which means they are not secured by any collateral. That means debentures are not secure by access. So if the companies fail in the project, that means the company may not be able to pay off all the debts at the date of maturity. So the default risks for the companies issuing debentures will be higher. Okay, let's turn back to deposits. Okay, right here you're going to learn the differences between savings deposits and term deposits. First of all, the deposit period for savings deposits is not fixed, just like EPS. Okay, you just put the money in the bank and withdraw the cash as you like. That means the deposit period is not fixed. While what we're talking about the term deposit is that the deposit period is fixed, just like a 3 months term deposit, 1 year term deposit, within which you are not allowed to withdraw the cash out of the bank. Talking about liquidity, okay, I give you a note for liquidity, which means the ability to turn into cash at short notice. That means a short period of time. For savings deposit, it is obviously higher. It has a higher liquidity than term deposit because for EPS, you may take cash out of the automatic teller machine as you wish, while term deposits, you're not allowed to get your money on your wish. For interest return, because of the higher liquidity for savings deposits, the interest returns is obviously lower because you have a higher flexibility to get your money. But for term deposits, because the bank has to use your term deposits for investment, because of lower liquidity for term deposit, the interest return for you will be higher because you give up the flexibility of getting money as you wish. Talking about finance in life, you are advised to know the deposit protection scheme. This scheme allows all deposits denominated in Hong Kong dollars, renminbi, or any other currency deposits such as pounds, Deutschmark, so and so in Hong Kong are protected. But there are a limited amount. Okay, the maximum amount under protection is up to 500,000 Hong Kong dollars only. But there are still exclusions from the scheme, which will not protect term deposits with a term more than 5 years. Foreign currency linked deposits and equity linked deposits. The word linked, it means the amount of deposits will be linked to the fluctuation of foreign currency or equity. Equity means share price. That means the risk of such deposits denoted in yellow color is very high. Okay, let's turn to bonds. Okay, bonds are debt contracts. Okay, as you read, you may call it debt instruments. Okay, or debt contracts, which represent claims for repayment at the maturity date. Bondholders are creditors, or you say lenders, of the issuing institutions. That means the bondholders are lenders of money to the issuing institutions. But you should learn more about the I-bond. I-bond means inflation-linked bond, because this bond is issued by the government. As you read before, bond is usually have a lower default risk because bond is usually issued by a government without specific purpose. I bonds, the I here is that stands for inflation linked. Linked means the interest paid is flexible, will fluctuate depending on the inflation during the period of time. You see on the right side, the interest rate will fluctuate from 2.37% to 4.95%. This is the debenture certificate for your reference. Okay, you see just like a certificate, just like a report card on the small unit. So it's okay to represent the debt contract of the issuing institutions. You know, the number of debentures is 100 only, 100 only here. Okay, you see the number of debentures, and you see the meanings of debentures that have been read before. Some terms on the bonds should be noted. Okay, the first one is maturity date. The maturity date is a stated end period of the bond. For example, 31st of January 2020. Okay, long years ago, later. And a bond has a par value on it. A par value is the nominal value of the debt. For example, maybe a bond has a denotation of $100,000, and we have the coupon rate for the bonds. A coupon rate is the interest rate of a bond. Say, for example, 10% per annum. We're going to look at the return of a bonds. Because of the regular interest received from the bonds by the issuing institutions, we can get the coupon payments as well. If the bond price appreciate means the bond price increase, we can get profit by selling the bond in the bond market. But you have to face the risk. The risk is that there may be a default risk. Default risk means the company, the issuing institution, may not be able to pay the debts at the date of maturity. And if you want to get money by selling the bond in the market, you may not be able to sell the market because the trading volume or turnover in the bond market is very low. That means only a few investors will trade bonds in the market. As well, you also face interest risk because when there's a trend of increasing interest rate, that means the bond price will decrease. You'll get loss by selling the bonds in the bond market because the price is getting lower. Another one is called reinvestment risk, or reinvestments. That means once you get back the money from by selling the bonds in the market, you get the money back, but there will be a risk of reinvesting this amount of money in another investment. That means you may not get sufficient return or good return by investing in another investment tools. We call it reinvestment risk. Next, about stocks. Stocks, you have learned in the types of business ownership. Stocks as a meaning of shares, which represent the ownership of a company. That means you are the boss of the company. Shareholders are actually the boss, or you say owners of the company. As you learned about shares or stocks, one of the characteristics is that shareholders have voting rights, and they share proportionally, and they have a preemptive right. Preemptive right means they have the priority to buy the new shares issued by the company. In this case, the present shareholders can maintain its proportion of shares in the company. They may want to maintain the sufficient number of voting rights in the board of directors. So preemptive right can give the current directors of the board to vote for their own. Of course, you should know preference shares and ordinary shares. But remember right here, preference shares, even though they are the shareholders are owners of the company, but they have no voting rights. You are reminded the preference shareholders have two preferences. Okay, one preference is to claim dividends before the ordinary shareholders. Okay, I repeat, they have the preference shareholders have the priority to claim dividends before the ordinary shareholders. And the second preference is that upon liquidation of the business, I repeat, upon liquidation of the business, that means the business going bankrupt and the assets have to be sold off to pay to settle all the liabilities. After which the residual claims is first given to the preference shareholders before ordinary shareholders. Talking about the returns of shares, shareholders can get dividends. Dividends claim declared by the board of directors. Second, buy low and sell high. To remember this rule: buy low and sell high. So if the share price appreciate means rising up, the shareholders can get profit by selling the shares in the stock market. But of course, shareholders have to face risk. One of the risks is the dividends are not fixed, are not sure. Okay, the shareholders cannot be sure that they can get dividends every year. And second, share price. Remember, we fluctuate. Once the shareholder need money right now, while the share price is getting lower, if the share has to be sold immediately to get back the cash for emergency use, the shareholders will face losses. Of course, company will go bankrupt. Of course, the chance may be very low. You should also face such kind of failure risk. Let us look at the difference between bonds and stocks. About the role of the investor, bonds is the creditor of the firm, while stocks is the owner of the firm. For the returns, bonds receive coupon payments, while stocks receive dividends. Well, when the bond price appreciate or the share price appreciate, both holders can get profits. How about getting back the capital? Remember, I've told you that the bondholders are the creditors or lenders of the issuing institutions. They can get back, they have the priority to get back their capital when the company is liquidated, while the stockholders are owners of the business. They are the last to get back their capital. About voting rights, bondholders do not have voting rights, while shareholders have voting rights. Of course, we should distinguish the preference shareholders and ordinary shareholders. Preference shareholders do not have voting rights, while ordinary shareholders have voting rights. Again, let us summarize the differences between deposits, bonds, and stocks in terms of risk and expected return. You'll see they go in the same direction. That means if you can do a higher risk, the expected return will be higher. Of course, if you want less risk, the expected return will be lower. Look at this. Okay? Deposits have a lower risk, so the expected return is lower. Bonds, lower risk, expected return lower. Stocks higher because of the fluctuation of share price. Okay, and the expected return is high as well. They go in the same direction. Okay, to see if you know to pick the correct answer. A, savings deposits. How about the risk, high or low? Yes, good, low. How about expected return? Very simple, low risk, low expected return. Very good. Term deposits, Again, low when compared to bonds and stocks. Again, low expected return. Bonds, lower risk when compared to stocks. So expected return is low. Stocks, of course, high, and expected return is high. Let's move to another subtopic about personal financial planning and different life stages. First of all, you should know the different types of life stages. Okay, first one is young single stage, second couple, third stage early family, the fourth stage is called late family, the fifth one pre-retirement. How about the last? Right, of course, retirement. Six life stages. The first stage is the young singles life stage. You'll see that the child stage is excluded from the life stage, although a child is a step before young single stage. We are not talking about child stage because during the child stage, all children are taken care by your parents. They do not need to plan their financial needs. All right. Let's go to young single stage. This one, the characteristic is you just start your career. You have left school and you start your career or your business. All right. The financial needs is the most important of all is to create and accumulate wealth. That means you should not overconsume, spend so much money without leaving money for savings. Because accumulating wealth is very important for later stage. Of course, right now, you should plan for later stages. And some examples is you have to plan for home purchase. That means to buy your flat, and maybe you go on for further education. You are going to marry. You have to support your parents. Of course, you have to pay tax. Okay, the second stage is called couple. Couple, of course, is a stage when two individuals get married. The financial needs of for couple is that you have to prepare to have a family, to have a children, to buy an apartment. So examples again, you have to bear children, uh, to buy an apartment. You have to buy insurance against accidents, and again, you save for retirement. About early family, the characteristic is very simple. It's an extension of a couple with a newborn baby. The financial needs are you have to plan for family expenses, such as children's education fund. You know, rearing a child is very, very expensive. And second, you should have a strong insurance coverage, much stronger than before. Examples: you have to set up a fund for child's education. Again, if you have not bought your apartment during the couple stage, right now you are going to save more to buy your home. Okay, or you may save for retirement again. About late family, the characteristic is the newborn baby has become a teenage, just like the picture. It has grown up. The financial needs is different because the children do not need much expenses for junior education, but you have to prepare money for his or her university education. As well, you have to save more for future medical expenses and retirement because you're getting old now. Examples, you have to prepare for children's university education. About retirement, okay. The characteristic is the children become young singles or they may become financially independent. That means they will not rely on parents anymore. And the financial needs are different. During this stage, you have to direct more financial resources to retirement planning and medical coverage because you are getting old. Medical expenses is a major consideration during your pre-retirement stage or retirement stage. Examples, retirement planning, maybe you go try to travel around the world, very happy life, and medical expenses as well. All right, retirement characteristic is the final stage of financial planning. The financial needs, of course, health insurance is very important. You should plan for the estate planning. Estate planning means you may have some property left for your ancestors. So you should have a good planning. Examples, estate planning. Okay, quick quiz to see if you know. A, create, accumulate wealth. Which stage it should be? Yes, young single. Plan for medical expenses. Yes, pre-retirement. Save for family expenses. Family. Yes, of course. Married with young children. Prepare to have family. Of course, couple. Estate planning. Estate means property left behind. Of course, retirement. Yes. Okay, let's move to MPF, a mandatory provident fund system. You should know in MPF scheme, you should know employees' rights and responsibilities. Well, you should know self-employed persons' rights and self-employed persons' responsibilities. We are looking at the features of MPF system. What MPF system is a mandatory? You know, mandatory, that means compulsory, no choice, compulsory. Okay, privately managed, and not managed by the government, but managed by private insurance company or banking industry. Fully funded contribution scheme. And MPFA regulates and supervises the operation of the MPF schemes. This one is called Mandatory Provident Fund Schemes Authority. What MPF system targets is for regular employees and self-employed persons aged 18, just an adult, okay, to 65, retired. The reference income levels should be around $7,100 to $30,000. So over $30,000, the part will not be contributed, need to contribute profit in the scheme. Mandatory contributions of employees and employers is 5% of employees' relevant income. That means the maximum income level is $30,000 out of 5%. That means $1,500 to be contributed by the employer. But the employer does not need to pay an extra amount out of the $30,000 income. Exempt person is domestic employees, just like the person in the picture, and self-employed hawkers. Hawkers, okay? Remember this, not other employers. What are the rights and responsibilities of employees? Just like you. You, employees, as an employee, can receive contributions from employers. It is your right. Second, you can change your scheme. That means you can, if you don't like the return of the scheme, the current scheme provided by one company, you can change the scheme from this company to another company, trying to get a better return. Third, you can change the allocations of the contributions in the MPF scheme, your contribution, okay? That means you will contribute 5% out of your incomes, okay, subject to the maximum of $30,000. You may change allocations of your contribution. But remember, you still have the responsibility to make mandatory contributions to the selected MPF scheme. And you should manage your accounts well. Manage your accounts well. How about self-employed persons? Self-employed persons. Those persons have the right to change the scheme, just like you. They can change the allocations of their contributions in the MPF scheme as well, just like you. The responsibilities of self-employed persons are to join the scheme. You have no option not to join and make contributions and update the information regularly. The self-employed persons must inform the trustee of cessation of self-employment. That means if the employed persons do not become boss anymore and work for another institutions, he or she must inform the trustee as soon as possible. Let's move to the rights and responsibilities of individual investors and consumers of financial services. For investors and consumers, we should know the rights and their responsibilities. Now, we should distinguish between individual investors and consumers of financial services. Let us look at the definition. Individual investors can make investments through intermediaries or invest in the primary market directly. Say, for example, if you are an individual investors, you want to make investments, you may ask a broker. Broker is an example of intermediaries to trade for you, to represent you to trade in the market. Or you may invest in the primary market directly. That means you may buy the shares. The primary market, that means the market that the new shares are issued directly to the investors. That means if you want to buy a newly issued shares, you may buy on your own. You may buy the shares in the primary market directly. And the second, consumers of financial services can make investments through intermediaries. That means they have no choice not to invest in the primary market, but ask somebody to help to make investments, what we call intermediaries, just like middlemen. Now we are looking at the rights of individual investors and consumers of financial services. Just like consumers, investors, of course, have the rights to what? To be informed. That means to be told of important information that is relevant to their decision, investment decision. Second, they should be responsible for investment management. That means they should have some intermediaries which are responsible enough to make wise investment decisions. They have the right to ask for the rationale behind investment recommendations. Say, for example, a middleman is going to tell you to invest in Hong Kong Bank, the shares of Hong Kong Bank. You may ask why they will invest your money in Hong Kong Bank instead of Tencent, which is a good potential of a share price rise. Fourth, you may obtain accurate information, very simple. Then you have the right to complain, you have voting rights because once you invest in the shares of a certain company, you are the owner of the company. Although the voting rights may not be great, but this is your right. You have voting rights. About responsibilities. You have to study information. It is your responsibility. Second, you should consider the risk and return. You should compare how much risk that you can bear. And you should understand the terms of a contract. Then you should monitor activities of your account regularly. Okay, Finance in Life. This is for your information. The Investor Education Center can educate public with skills and knowledge to make appropriate investment decisions. If you serve the internet of this center, you may know a lot of information how to invest and make appropriate investment decisions. Okay, quick quiz questions. What is the difference between investors and consumers of financial services? Discuss the definition between these two parties. Okay, investors invest in the primary market directly, while consumers of financial services make investments through intermediaries only. Second, if a consumer of financial services find that his investment have been mishandled, this is about complaint. Okay, complaint. What can he do? You can complain to where? Hong Kong Monetary Authority. Okay, remember this. You can complain to the Hong Kong Monetary Authority. Okay, case. Mr. Lam's investment experience. Mr. Lam's premise are very happy. But once we receive a statement, you see the drop by 80%. That means he loses 80% of his initial investment. Ask why did I lose so much money? Okay, first one. Which life stage is Mr. Lam at? What are his major financial needs? Mr. Lam has not been married, so he is a young single. And he needs to create accumulative wealth and plan for the later stages. You do know that this is the note in the PowerPoint before. Here's a consumer of financial services. Okay, what rights does Mr. Lam have? Name 3 of them. So read the notes. Responsible investment management, ask for the rationale behind the investment recommendation, obtain an accurate information, and the right to complain. And it's free. Some problems with Mr. Lam are here. Mr. Lam should have checked the statement of investment account. He should monitor his investment account regularly. That is his responsibility. That's the end of chapter 3.